Good afternoon, and welcome to People Making Money, one of the Way to Wow shows. I'm your host, Kevin Bemmel, and through December 6th, we will be here every every Wednesday at 12:30 p.m. Pacific time, 3:30 p.m. Eastern time, to talk about all things related to our professional lives, to wealth building, and all of those things related to people making money, right? Um, and the reason I say until through December 6th was starting on December 13th, we're going to be moving to 10 a.m. And that will align all of my shows at a 10 a.m. Pacific time start time, so that we can be together or plan to be together at the same time, Monday through Wednesday. And who knows, maybe Thursday and Friday as well, as I extend the various shows. But that way, it's not sort of fluctuating during the day, which I'm not sure why I did it that way in the beginning, but you live and you learn. So today, it's a lovely rainy day here in Los Angeles. And for anyone who's ever lived here, you know that lovely and rainy don't often are not often words used to describe Los Angeles, but indeed, it started raining here about an hour ago, and it's on the chilly side. It's finally, kind of fall weather here. It is, already halfway through, or more than halfway through the fall season, 2/3 of the way through. So I have my candle here to remind me that it's a little gloomy wet and gloomy outside. I have another candle back there. See, so you can tell how excited I am about the rain. My daughter and I have been exchanging text messages because we love the rain. One of our favorite things is to put on raincoats and rain boots and go walking in the wet weather. But I'm working and she's in school, so not today. But who knows? Maybe over the weekend. So getting back to our purpose in being here, you don't tune in to hear me ramble about beautiful rainy weather in Los Angeles. So it being the middle of December, excuse me, it is time, if you haven't already, to start thinking about planning for taxes, right? They say there's nothing sure but death and taxes. And we are making progress on the first one. Lifespans keep getting longer and longer, although they did shrink a little bit because of COVID. But I don't think we're ever going to get rid of taxes. That's just the way of the world. So I prepared a talk today on tax breaks for 2023 that you may want to take a look at. See if these will help you improve your tax situation. And we're going to be focusing specifically on those things that need attention before the end of the calendar year. Okay, so as has been my ever more frequent practice, I did put together a little PowerPoint, and you can see this is the PowerPoint theme for people making money. First of all, it's green, although I'm not sure why a wheat field is green, but it is. I mean, maybe the wheat isn't quite quite ripe yet. But I don't know. There's something about fields, rolling fields of grain that is attractive. So as is the case with all, for those of you who watched the shows before, as is the case with all of the Way to Wow shows, they're all based on the 3 pillars of attainment. We generally are here in the pursuits pillar, in the finances realm, and we're going to be really staying there today. Other times we do drift into the other 2 pillars, at least parts of them. So we're going to be looking at 7 issues for you to consider before year end, preferably as soon as possible. So if you do need to make some changes or some plans, you have time to do that. Okay, so really don't want to wait until, you know, the week between Christmas and New Year's to be dealing with these things. First of all, you know, people want to sort of relax into the last few days of the year. Second of all, there are a lot of parties going on. It's a time for socializing and all of that. And third, there just may plain not be enough time to execute any particular strategy. So I do encourage you, if you do your own taxes, that you jump on these things right away and take a look at them yourself. If you work with a tax preparer, an accountant, or whatever, I encourage you get in touch with your accountant and see, you know, what it is that you may need to do or can do to positively affect your tax situation. So we're going to go through these one by one. Oh, it's just so, I'm not sure why it does that. So weird how it advances itself. Okay. So let's start out with withholding and estimated taxes. So for most people, they're having income taxes deducted from their salary with each paycheck. Okay. However, that doesn't mean that you're having, that doesn't necessarily mean you're having enough withheld to cover your tax liability. So before I get into the specifics of this, I do feel obligated to explain something, and that is that while withholdings are a part of how salaried or you know, employees work, the reality is when we have taxes withheld from our paycheck, what we're doing is we're giving the government an interest-free loan. Okay, so let's say over the course of a year, you know, you pay $15,000 in withholding. So what that means is, instead of accumulating that money in a savings account and paying it out at the end of the year and earning some kind of return on that, maybe it's just 5%, maybe it's 10%, you're getting nothing on it. Okay, so let's look at this. If it's, let's take $10,000. That's an easy number to deal with. So if you have $10,000 deducted in you know, from your paycheck, roughly $800 a month. Okay, over a 1-year period, you're losing out on what amounts to probably somewhere between $300 and $500 in interest. Okay, even just at 5%. Now, if you could have put it in some kind of money market fund, not money market fund, I mean mutual fund, that does well, maybe you're losing, maybe you would have gotten a 10% return, and at you know, at $10,000 accumulated over the year, you know, that may be more like $500 to $700 in lost income to you. Now, I'm not saying therefore that you shouldn't have withholdings. All I'm saying is we need to recognize what we're doing and what we're giving up. So as long as, if you get to the end of the year and you have not withheld enough in taxes, as long as you've got the money there to pay it, that's not a big deal. Okay, and in fact, in some ways it's better, because you've been getting hopefully some kind of return on those funds over the year, and that works to your benefit. Okay, the flip side is, if you have under withheld and you do not pay enough estimated taxes at the end of the year in order to meet the threshold, you'll pay an underpayment penalty of 8%. Okay, so excuse me, let's say that you have it come April, your tax liability is $10,000, but you only have had withheld $8,000, so that $2,000 is now subject to an underpayment penalty of 8% or $160. Okay, that's a big penalty. By the way, there can also be interest on an underpayment. So here's the thing. In order to avoid an underpayment penalty, you either have to pay 90% of your tax liability by the April deadline. Sorry, yeah. Yes. I'm sorry. I'm having a moment here. So you have to pay 90% of your tax liability by the April deadline, or you can pay 100% of the amount you paid in 2022 for if you have an adjusted gross income of up to $150,000 for this year, or 110% of your 2022 tax liability if your adjusted gross income for this year exceeds $150,000. Okay, so that may sound a little bit complicated, but let's say you took you got a big increase in salary this year. So let's say you went from $90,000 last year, or let's make it even. Let's say in 2022 you made $100,000, and let's say this year, 2023, you're going to make $200,000. Okay, and part of that, let's say a lot of that is in bonuses or whatever. Well, as long as you pay 100%, as long as you've paid 100% of your 2022 taxes for this year, you're okay, even though you'll end up owing a lot of money come April. And it may be better for you to do that, because in the meantime, that additional money that you would have paid, that you'll have to pay in taxes, can be earning additional interest or additional income. And then come April, you'll pay the balance. Okay. And then, all right, your taxes are paid, you paid no penalties. All right. And you're good. So my point in bringing this up is, it is, as long as you are making sure that you have the money you need to pay the taxes by the different deadlines, the fact that you may owe money to the government is not a bad thing. Okay, you certainly when you get I know a lot of people look forward to getting a refund when they file their taxes. What that really means is not only have you lent money to the government tax-free during the tax year, but they've held additional money that belonged to you, interest-free during that time. And that's money that you definitely should be earning a return on. So give some thought to that. Obviously, the higher your salary, the higher the potential overpayments, the larger the amount that is being withheld, the more relevant this becomes. Okay, but this is definitely something to talk to your tax advisor about, to make sure you're hitting the right balance based on how you work the flow of your payments. Okay, so that's the first one. Second one, are you going to take a standard deduction, or are you going to itemize deductions? So it used to be a lot more people itemize, but now less than 10% of people itemize. Okay, so most people end up taking the standardized deduction, which for this year, you can see there on the screen, it's going to be a little under $14,000 for single filers or married people filing separately. It's going to be a little under $28,000 for married filing jointly or qualifying widows or widowers, which 26, 27, yeah, okay, it's double. Okay, and for head of household, it's $20,800. Okay. Now, just because you took the standardized deduction last year doesn't mean you need to do it this year or next year. So you may want to consider bunching deductions. So if you have certain expenses that you want that you need to take, okay, and you're anticipating those to be ongoing expenses next year, it may be more beneficial to wait until after the first of the year to start those expenses, kind of push them into 2024. And then at the end, toward the end of 2024, any that you might have delayed into 2025 sort of pull into 2024. So for 2024, it'll make sense to itemize because you've pulled in a bunch of additional deductions that justify itemizing. And then 2023 and 2025, you'll just use the standard deduction. So again, this is something to examine with your accountant or your tax preparer. Can you bunch deductions in a way that will make it beneficial for you to, at times, itemize deductions, and then the rest of the time just take a standardized deduction? Okay, so what are some of those bunching deductions? Well, they may have to do with unreimbursed medical expenses. They may have to do with moving expenses. They may have to do with there was another one that came to mind and now I lost it. Okay, but in any event, charitable deductions. So it may be that the way that you do your charitable deductions, if you bunch them in a way where instead of always giving at the end of the year, you actually give, for 2023, you actually give on January 1st, 2024, basically. For 2024, you give in 2024. And for 2025, you actually give on December 31st, 2024. That way you bunch them all into 2024. Especially if you're giving large contributions, so then they're aggregated in such a way that it might make sense for you to itemize for 2024, whereas you don't for the other years, and that's more beneficial. Okay, so again, something to talk to your tax advisor about. All right, and I don't know, now it doesn't, there we go. Okay, so charitable deductions. So in past years, there were amounts that you could deduct even for non-itemizers, meaning people who took the standard deduction, $300, $600. That can't do that anymore. Okay, those deductions are for non-itemizers are no longer available. So that's why they're talking about, this is what I was just talking about in terms of charitable deductions. You may want to bunch contributions in such a way that as a tax deduction, they become more valuable. Okay. Another type of charitable deduction to consider is to donate appreciated investments held longer than a year. Okay. And in this way, you're not having to pay the capital gains taxes on them. Okay. And so it's as if by deducting them, not only are you getting a charitable deduction, but you're also getting out of paying the taxes on it. Okay. For taxpayers 70 and a half years and older, they can donate up to $100,000 from a traditional IRA. Without and then they don't have to pay the taxes on it. Okay, so these are different charitable deduction strategies that, especially if you're bunching contributions, may make it worthwhile for you to itemize in a particular tax year. Okay, and thereby give you and thereby reduce your tax liability. Okay, so look, Americans in general are pretty generous people. I know, this has been a tough year for many between inflation, et cetera. So you may not be giving charitable deductions this year. And most of the charities over the next 6 weeks are going to be coming out with end of the year pitches for contributions. And it may be that if you're sure it's not worth itemizing this year, so it may be worth it to instead of making end of the year contributions, you still want to support that charity. So then make a January contribution, and you may just say to them, hey, I'm going to make a contribution right after the first of the year so I can include it in the next tax year. Okay. All right. So that's charitable deductions. I think that was the third one. Okay. Fourth, large investment payouts. So if you have mutual funds, real estate partnerships, or other investments, you check if they haven't already dealt with this issue. It's a good idea to check with them and see, are there going to be any large payouts before year end? Okay, and if the answer is yes, so then this is something that you're going to want to deal with now. Okay, so one way to deal with them is to harvest offsetting losses. So let's say that you've got a mutual fund that's going to be reporting a big capital gain, and let's say you happen to own another stock, and it's really it's dropped a lot this year, and so you're going to have, if you sell it, there's going to be a loss. Well, it may be worthwhile to go ahead and sell that stock and take the loss to offset the gain from the mutual funds, and thereby not pay any taxes on the mutual fund gain. Okay, and you might say, well, wait a minute, but if I sell it at a loss, I'm losing money. Well, that's true. I mean, you're going to want to speak to your financial advisor and see whether it is advisable to sell any particular investment at a loss in order to offset another gain. And so none of the things I'm talking about you should just go out and do. These are things to talk to your advisors about. But it may be a way of reducing your tax liability. Okay. And if you do sell a stock at a loss, well, you still have the funds from selling it, and you can invest them in something else, maybe redeploy that capital into something that will perform better in the future. Okay. So that's the kind of conversation you want to have with your advisors. If you're not going to harvest offsetting losses, the other thing you may need to do is look at increasing your withholdings or making an additional payment such that you don't get caught with that underpayment penalty that we were mentioning back here, right? You don't want to get caught with this 8% underpayment penalty. Okay, and that's based on your adjusted gross income, which is going to include income from investments. Okay, so that's why, again, you want to take a look at this now, because you may need to make some adjustments to ensure that you don't end up owing the government even more money because you didn't meet the various deadlines for when taxes need to be paid. Okay, next, an EV purchase. So there is a $7,500 credit, tax credit available if you purchase an electric vehicle. Okay, now you've probably heard, if you've been following the news, that a lot of car companies have really what amounts to excess inventories of EVs, and they're cutting prices and they're making deals. So if you are considering buying an electric vehicle, this is probably a good time to look into it in earnest to see, should you buy it this year, or should you buy it next year? Now, there's at least a couple of factors that need to go into the mix of making that decision. In 2023, if you buy a car, an EV this year, you don't get the $7,500 tax credit until you file your return. Now, if you're going to file your return right after the first of the year, that may not really be such. If you're going to buy it, December 30th and file your tax return on January 2nd, maybe that's not a big deal. But if you're thinking about buying it now, and you typically don't file your tax return until March or April, so then there's a several month gap there. Next year in 2024, when you buy an EV, you'll get the $7,500 tax credit at the time you purchase the car, so you get it essentially immediately. Okay, here's the thing though. There may be fewer eligible vehicles next year. So if you wait until next year to buy an EV, you may not be able to get the particular vehicle that you want and still get the tax credit. Okay, so these are the various issues to look into if buying an electric vehicle is on your your to consider or to-do list. Okay, and even if even if you're not at all sure you want to buy one this year, but you're pretty sure next year you're going to buy one, I do recommend you take a look at it now, because you may find that for your particular circumstances, it actually would be better to accelerate that purchase into this year rather than waiting till next year. The flip side is, you may find, hey, it really doesn't matter whether I buy it this year or next. So since I'm not motivated to buy in 2023, okay, I haven't lost anything except for the time to investigate it and not wasted time at all. Okay, because we are talking about, significant sums of money here. Okay, so looking into an EV purchase is another potential tax break to consider for this year. Okay, next, if you have IRAs, okay, typically you have required distributions you have to make. So I wrote these out because they can be a little bit complicated. Normally, I don't write out paragraphs on my PowerPoint slides. So for an owner of a traditional IRA that was born in 1950 or earlier, meaning you're either you're 73 or older, okay, you must take required withdrawals for 2023 by the end of this year, okay? And the payouts are based on the account value as of December 31st of 2022. Now, it can be tricky to calculate what the minimum required distribution is. So this is a situation where you really want to talk to your tax preparer, your accountant, whoever it is you're working with, to make sure that it's done right so you don't end up paying penalties. The penalties can be very high, I think as much as 50%. All right, so you really don't want to do that. Okay, now, for heirs of traditional IRAs whose owners died in 2020 or later, they normally take required withdrawals this year. However, the IRS is allowing heirs to skip them for 2023. Now, there may be some qualifications on these to your particular circumstance. So again, I wouldn't recommend you just skip taking a withdrawal. Talk to your accountant, make sure that you're in compliance so you don't get hit with penalties. But in any event, if you have any IRA accounts at all, and you either already have started to take required distributions, or you've hit I forget what the age limits are, 59 and a half in some cases, and so it may be time for you to start taking distributions, or you may be eligible to start taking distributions. Okay, it's worth a conversation with your tax preparer or your accountant to make sure that you're handling these things correctly. Okay, 15-20 minutes talking to your accountant, even if you have to pay him, is a small price to pay for not making a mistake when it comes to IRA distributions. Okay, so now these generally, we're talking about traditional IRAs. Roth IRAs have different rules, and so you know, you don't have to be as concerned about those. But for a traditional IRA, definitely take a look at them. You know, in the very near future, the next couple of weeks, to make sure you can do any planning or make any changes before year end if necessary. Okay, so what can wait then? This is the last of the 7 issues. So contributions to traditional IRAs, Roth IRAs, health savings accounts for 2023 can typically be made until the deadline for filing taxes next year, April 15th, 2024. Okay, and in Maine and Massachusetts, for some reason, it's extended to April 15th. I don't know why that is. All right, now, for some self-employed filers, they can make 2023 contributions to solo 401ks until October 15th of 2024, which is the extended deadline to file your taxes. Okay, so maybe you had a really tough year this year, and next year things improve. And again, this is something to talk to your accountant about. Does it make sense to use some of the additional money you got, or some of the additional income you got next year to fund a solo 401k for 2023 to reduce your to reduce your 2023 tax liability? So those are the kind of things you can look at. But these are ones that can wait till after the beginning of the year, generally speaking. Now, if you're going to have a tax planning meeting with your accountant anyway, so then I would go ahead and discuss these matters too. Just make it as comprehensive as possible. And even though you may not execute on the strategy until next year, at least you know what to do. So, you know, be as comprehensive as you can. I know from when I was in my real estate company business, my accountant insisted that we have a sit down, usually I think end of October, early November, to go over all the various tax issues that might affect me and my business, so that I knew what to do over the next 3 to 4 months between that meeting and when he was going to be filing my tax returns. So it was always a worthwhile meeting. It was money very well spent. And over the years, he saved me a tremendous amount of money in taxes as a result. Okay, so that's all I've got for you. It's kind of a short show today. Only a half an hour. Normally we spend about an hour together on Wednesdays, but today, like I said, it's going to be shorter. So if you have any questions, comments, thoughts, concerns, you can always contact me. All these will be in the show notes. If it's something, as always, if it's something of a personal nature, please don't post it please don't post it on social media. Send me a direct message or an email. And even on an email, please don't send me documents and that kind of stuff. Those things can go astray, and all of a sudden your personal information is now out of your control. But I'm happy to, if it's within my scope of knowledge, answer your questions, and if it's not, refer you to the appropriate professional to make sure that you get good advice. Okay, and we have just the legal stuff here to finish it up. Back and forth we go to finish things off. So let's go ahead and stop the share. So that's what I have for you today, and that wraps up our shows for this week. So I thank you very much for joining me. I hope you found this useful. And next week, Starting on Monday at 10 a.m. is Trusts and Estates Weekly. And then on Tuesday, now at 10 a.m., we were meeting at 11 a.m. These are all Pacific time. So now 10 a.m. Tuesdays is Business Lessons from the Military. Okay, and we're going to be continuing our discussion of intelligence. And then 7 days from today on Wednesday, I'm sorry, take that back. Next week is Thanksgiving week. So we'll have some classic episodes for you at 10 o'clock Monday for Trust and Estates Weekly, 10 o'clock Tuesday, Business Lessons from the Military, and at 12:30 p.m. Pacific time on Wednesday, a classic episode of People Making Money. And then we'll be back with live episodes again the following week. So wishing you a wonderful rest of the week, and wishing you a wonderful Thanksgiving week. I hope you get to spend your time with family and friends and relax for the holidays. And, as always, probably eat a little bit too much turkey and pumpkin pie. That's the only time I eat that stuff, really. But enjoy. And again, thanks for joining me here on People Making Money, one of the Way to Wow shows. And while we're talking about Thanksgiving and gratitude here for a minute, I do want to thank all of my subscribers for subscribing to the show. I really appreciate it. The sort of vote of confidence it gives as I grow my audience. And if there's a topic you want to learn about or hear about, please don't hesitate to let me know. And if you're a subscriber, tell me you're a subscriber. It's like, hey, Kevin, I'm a subscriber. I've been a subscriber for, 2 years. I've never seen you do a show on the following topic. It's like, wow. Okay. So there you go. I will do a show on that topic. And for those of you who are not subscribers, if there is a show you want to see, by all means, let me know about that. I'm happy to put together a show based on your interests and concerns. Finally, if you are involved in trusts and estates, if you're trust and estates, and think you have a topic that our viewers would be interested in, let me know about that. Perhaps we'll have you as a guest. Likewise, if you're involved in the military, either you are a service member or you're a military historian, something like that, by all means, let me know about your idea for a show on business lessons from the military. Would be happy to talk with you about that. And if you have an interesting way that you make a living, or an interesting way that you've gained professional success, if you're involved in helping people build wealth, by all means, let me know about that, because I'd love to have you as a guest here on People Making Money. I do have a number of guests coming up in the next several weeks. I think you will find them interesting, as well as informative. And who knows, maybe you will be the next guest that I schedule. So once again, thank you for joining me. And I hope wishing you a wonderful rest of the day and week. And signing off as I always do. Marie, you're my belle, darling. All the best, folks.